Hello, this is Robert Rayburn here at Life Pro Asset Management. It is March 25th of 2024. Unbelievable, but it's already the end of the first quarter of the year. But the good news is that we continue to make progress. And we look back to the beginning of the year, we look back to 2023. We really sort of had three steps here. First was obviously we wanted to, coming off of 2022, make sure that we could be in a place where the portfolios were not going down in value, right? That was the first step. The second step was getting them to rise in value. And then the third step is to start to generate alpha or reposition the portfolios so that we're generating long-term outperformance. And right now we're in the midst of what I call the early stages of step three, where we really want to try and target alpha for the calendar year. So far, with call it half an inning left in the first quarter, we are starting to come into a picture where I think that alpha is starting to get generated there. And we definitely want to keep that up. We're again very early on in all of this, and I think we're positioned the right way. We look at the portfolios, we continue to be biased with value over growth. When we look at the broader growth picture, growth and technology stocks are increasingly supported by a narrowing breadth picture across technology. So we don't want to rush back in. But certainly if we are right and technology does significantly pull back, I will be the first one to say that, hey, we want to start looking for opportunities across that space. We're just not there yet. I think we're just at the very beginnings of this. We continue to see major leading names such as NVIDIA that are sitting near 52-week highs. We have seen a breakdown in names such as Tesla and Apple, and we've seen the relative strength start to deteriorate in Microsoft and Google. That said, the semiconductor space continues to remain robust, and we think that's probably the last domino to fall within tech. So no need to rush into that space. We want to focus on cheap names where earnings growth is above average and where there are specific identifiable catalysts that we can realize for clients here in 2024, because that's important. You can be right on a call, but your timing can be way off, and timing is important. And it's something that we've learned over the last couple of years is to hone in on our timing. So that's sort of a quick Q1 there review. But what we wanted to do this week was really focus on oil prices. It's a big overweight. It's our largest overweight in the portfolios across all of our equity sleeves. And for us, we want to understand why now. Why are oil prices rising today and not in Q3 or Q4 of last year or this year, right? So why do we think it's happening now? Will it continue? And how do we position portfolios to benefit from that? So three things overall that we want to go through this week, aside from rising oil prices, is market breadth. We continue to see it expand. There's a rotational factor there. So not the same areas are expanding as they were 3 months ago. So we want to look at what is working now and what may not be working in Q2. Number two, the economy and credit markets continue to remain pretty solid, and we don't see a whole lot of red flags there. A lot of people trying to nitpick and find some obscure data point that's saying, hey, like the economy is going to collapse in the next couple of months. I mean, maybe that happens, right? The economy ultimately is a very hard thing to forecast. It's got many moving parts, but overall, it's hard to throw a lot of mud at this economy right now. Outside of the inflation factor, that's the one thing that remains stubborn, and we're positioning portfolios to deal with the above average inflation. And then lastly, we do think something is happening in energy, something positive if you are an energy shareholder. And so we'll go through all of those reasons this week. So in terms of rotation, what we see here is the percentage of stocks at 3-month highs within the S&P 500 is approaching that 30% threshold. And that is important. So when we look at the average 12-month S&P 500 performance following consecutive trading days with 65-day highs above 30%, what we see is above average returns. Now, the key here is after 6 months or so, or 125 days, we want to see those new highs stay at around 25 to 30%. Otherwise, you start to get a fading of performance. It doesn't go negative, but it's not as robust as these 12, 14% figures suggest. So right now we're kind of right in and around right here. So we like the way the broader market is set up. Yes, it is overbought, but let's go back to what we've been saying week in, week out, is that most of a bull market's life is spent in an overbought condition. It's an overbought condition is reflective of investors chasing a good situation, of an economy that remains robust, and of course, more and more companies participating in that rising tide. So it's when the market hits new highs and you have narrowing breadth, that is really where we take a step back, throw the yellow flag up, and say, you know what, we need to exercise with more caution here. The one area of the market that is not seeing rising breadth, of course, is technology. So unlike the S&P 500, where you're seeing more and more stocks participating in the rally, within the technology sector, you're actually seeing fewer and fewer stocks. Now, that is masked by the strength in semiconductors. And headlining that, of course, is NVIDIA. That is masking a increasingly fragile sector. If we look at the software sector, names like Adobe continue to break down. ServiceNow continues to break down. These are big names, Salesforce, etc. These are big names that are breaking down. When you look at semiconductors, certainly you're having some robust action there, but then increasingly underneath the hood there, fewer and fewer stocks hitting new highs. And we think that just a more robust economy is increasing the likelihood that investors are noticing those really high valuations within tech, people hiding in the Magnificent Seven, thinking that the economy is going to deteriorate and there's only one place to get growth. Well, guess what? When the economy is healthy, when the economy is sustainable, when growth looks good, and you got cheap names that are growing a lot, I got to pull money from somewhere. And it comes from the Mag 7. We sell those and we buy the rest of the market. And so we think that it continues to happen slowly, silently, and then all at once is what happens there. So we look at the economy, jobless claims, pardon me, continue to be near cycle lows, 210,000. If you go back to the 2010s, 210,000 rarely happened. And now we're kind of in this cycle where, 50-year lows are the norm. Sometimes we were at 180,000, sometimes we're at 220,000, 200,000. All of those numbers below 250,000 are very, very robust numbers. And so we don't want to make a mountain out of a mole. So when you see a little bit of a pop-up here, it's like, okay, watch it, but don't blow the portfolio up over it. And so overall, 210,000, again, near 50-year lows. I think that's like the real sustainable point here that we want to emphasize. Continuing claims, again, a little bit higher, but nothing, again, to sneeze at. There's a bit of a lag factor there because of this pop over here. So I suspect you'll actually see this flatten out and reverse here in the next couple of weeks as well. When you look at the credit markets, in corporate credit risk spreads, right? So remember, low is good, high is bad. High means that companies are paying more to borrow money because investors are perceiving more risk in their business model to a bad economy, a bad company, or whatever that is. When this line goes down, it means it's cheaper for these companies to borrow money relative to the US government. That's a good thing. So when implied credit risk continues to drop to cycle lows, it's not really indicative of rising recession risk within the credit markets. And typically, it's not a rule written by God, but it is certainly historically, you tend to see hints of recession come from the credit markets prior to equity markets. That's why we watch the credit markets so carefully. Now, within the credit markets, you have really safe stuff like government bonds. You have safe stuff like investment grade corporate credit. You have less safe stuff like high yield bonds. And then you have riskier types of bonds called leveraged loans. Leveraged loans tend to catch the cold first when the economy starts to do poorly. Now, this is a price chart, not to confuse before with a spread chart. This is a price chart. So in this case, when the price of a leveraged loan goes up, that's a good thing. When the price of a leveraged loan goes down, that's a bad thing. And so when you see this price going up, it is suggestive of, again, not a lot of symptoms of something lurking within the credit markets that can impact the broader economy. So again, really good symptoms here across credit markets, whether we're looking at bond spreads, whether we're looking at government yields, the yield curve, whether we're looking at leverage loans. This would be the credit markets would be equivalent of a 25-year-old patient going to the doctor with a six-pack and really at the end of the day not having any major health issues. So credit markets look very, very, very robust right now. Which then leads us into this, if there's one anomaly here with an overbought market and the expectations that the Fed is going to cut rates, well, if you think the Fed's going to cut rates into a fairly robust economy, perhaps you do want to buy speculative growth, right? Because speculative growth really feeds off this idea of cheap money and not having to make earnings in year one or year two, but you can push that off to years 4 and 5 and massively dump money back into the business to capture real estate against your competitors. That has been increasingly not the case this year. So we started the year with 7 rate cut expectations for the year. And if you go back to our December, January, February weekly updates, we've been very, very persistent on this when no one was there, that we do not believe or see the reason why we would cut rates as a country when the economy is strong and inflation remains above target. We're still in that camp. We're with inflation just below 4%, which is almost double the target, a very strong economy, right? That's not a political statement by any means. Just we have a strong economy that's feeding above average inflation with low unemployment. If you cut rates, inflation will likely go from 4 to 5 or 5 to 6. And then we have a situation where we might be looking at 6 or 7% interest rates. So for us, we continue to think this number is biased lower, right? Unless, of course, the economy weakens, then the Fed can respond. Do we think there will likely be a rate cut? One? Yeah, probably. Why? Because the Fed's kind of talked themselves into that. But it could very well be a one and done. And so the real risk is right now is everyone's piled into the Magnificent Seven. And you see that with the Apple and Microsoft combined market cap here. That is literally greater than the entire Russell 2000. That's just not a normal symptom to us. And we think there's a lot of money hiding in there that will eventually find its way into the rest of the market. So bottom line here is we think the rotation goes into value at the expense of growth. We're focused on energy, emerging markets, what we call orphan growth. That could include areas like auto dealerships or cannabis, stuff that hasn't necessarily recovered with the rest of the growth space, and then materials and banks. Our energy bull thesis, we've seen that rising oil price. We're in a seasonally great time for oil as we get into the summer driving season. Global oil demand is rising. That's an irrefutable fact. We can talk about EVs and all this kind of stuff. Consumption continues to go up. And maybe one day we'll send out a webinar kind of breaking down why EV is a very, very poor fundamental story in terms of the economics of building an EV car. But China and Indian consumers are on the upswing, right? We're seeing more and more consumption out of those countries. There's supply constraints. OPEC is near multi-year lows in production. Some of that is self-imposed. Some of that are capacity issues. With Saudi Arabia, it's a mix of the two. In the US, production has gone up, but it's starting to flatline as efficiencies come down due to a lot of the best oil wells being drilled within the Permian Basin. Shale consolidation, we're seeing more M&A within the shale space. We've seen it in our own portfolios. That's leading to higher dividends and higher buybacks. And guess what? Less capital into the ground. So when those dividends are being paid out and those shares being bought back, those are dollars that could have gone into the ground. And then finally, valuations are just really, really attractive. And even with the recent rally, remain very, very attractive. And how scarce is oil? This is the inventory chart to the right. Picture says 1,000 words. I don't need to go into the details why. Inventories just remain very, very low. And we look at the energy sector as a whole, the percentage of stocks at 3-month highs spiking to 70%. The last time we had this consolidation and very long breakout was, of course, in early 2022. And that was accompanied by a cluster of spikes in terms of the percentage of stocks at 3-month highs. We think this is just the first. And we think we're coming out of this months-long, year-long consolidation within energy. And we could see this space significantly rise from here, in our opinion. And we're right in terms of timing. We talked about how we want to increasingly focus on the timing component of everything. Seasonality, from really February all the way through to July 4th, if you really wanted to break things down on a seasonal basis, this is the time for oil. Now, have there been times that counter this? Of course, right? It's not a rule, but historically, this is the time of the year that oil does really well because the market prices things ahead of time. We got low supply. We got maintenance of refiners in this time of the year. And guess what? We're starting to ramp up the summer driving season, starting with spring break, going into Memorial Day, and then, of course, July 4th. So in summary, the economy is humming along. We want investors to embrace this rotation from growth to value. Market breadth is expanding while tech breadth is contracting, and momentum across energy is accelerating. So that's what we got for you this week, 888-543-3776. Hope everyone has a fantastic week, and we'll talk again next week. Thank you.